Economic activity has rebounded. Growth quickened to 0.4% in the second quarter. That's from a flat performance in the first 3 months of the year. The uptick is largely due to gains in the finance, real estate and business services industry. The manufacturing sector also provided support. The outcome is in line with analysts' expectations, as most had expected growth of between 0.2 and 0.4% for the period. Shoprite has bagged annual profit growth. The supermarket group has posted a 7.2% rise in headline earnings per share from continuing operations. This was underpinned by a 12% rise in group revenue. That performance was largely due to the strength of the group's core South African markets divisions, where customers spent 21.4 billion rand more than the previous period. A full-year dividend of 7.12 rand has been declared. This is an inflation-beating increase of 7.4%. Shoprite has announced that the disposal of its furniture business, Pepkor, will be picking up that asset, which includes the OK Furniture and House and Home retail brands. The price tag is around 4% of Pepkor's market capitalization and will be settled in cash. Pepkor says combining Shoprite Furniture with Pepkor Lifestyle will result in a larger customer base and retail footprint. Shoprite's furniture business operates more than 400 stores in South Africa, Botswana, Lesotho, Namibia, Eswatini and Zambia. Solid. That's how Aspen's described its year-end performance. The pharmaceuticals giant has posted a 10% rise in revenue, led by its manufacturing division. It's also pointed to a strong showing from its commercial pharmaceuticals unit, which managed to absorb sharp price decreases in China. Headline earnings per share, meanwhile, decreased by 3%. Aspen, which has lifted its dividend by 5%, is optimistic about its prospects. The firm says its commercial pharmaceuticals business is now de-risked and is well poised for future growth. Motus says it's faced a challenging trading environment over the past year. South Africa's largest vehicle dealership has pointed to higher than normal vehicle inflation, rand volatility and high interest rates as factors that have weighed on disposable income. And this in turn has impacted the group's profits. Headline earnings per share fell 28% during the period. A final dividend of 285 cents per share has been declared. This takes the total for the year to 520 cents. That reflects a decrease of almost 27% on the previous year's payout. Ascendis has also flagged a challenging operating environment. The health and wellness companies posted a 4% decline in annual revenue. Ascendis has cited a poor showing from the scientific group and the compounding pharmacy. It's also pointed to challenges linked to Surgical Innovations' business rescue process. Profit for the period, meanwhile, declined close to 24%. Ascendis says its historic challenges have largely been addressed, and these efforts have positioned its businesses and the group as a whole to capitalize on future growth and investment opportunities. And China and South Africa have agreed to promote balanced trade and boost two-way investments between their industrial and commercial communities. That's according to a joint statement as the nation's two leaders meet in Beijing ahead of the 9th Forum on China-Africa Cooperation. Both sides called President Cyril Ramaphosa's visit of great significance to the development of bilateral relations. China is South Africa's largest trading partner. Volkswagen, in the meantime, is considering closing factories in Germany amid rising cost pressures. Here's more detail in this package report.
Volkswagen could close factories in Germany for the first time in its history. And that's a sign of just how much pressure Europe's top car maker faces from new Asian rivals. The company's Works Council has vowed to fiercely oppose any such move. It says VW has identified one large vehicle plant and one component factory as obsolete. The move will mark the first big clash with the unions for Chief Executive Oliver Blume, who had been seen as more of a consensus builder. He has told management that factors including a difficult economic environment and new Asian rivals demand action. The company has seen a sharp loss of market share in China, where it is struggling to compete with local players like BYD. All that has seen VW shares lose around a third of their value over the past 5 years. But the company employs some 680,000 workers and is a symbol of German industry, making it politically charged. The last time it tried to make major changes, back in 2022, the moves were defeated by the powerful IG Metall union. Now its new plans will be a worry for German Chancellor Olaf Scholz and his coalition government, already under pressure after losing a regional election to far-right rivals over the weekend. So far, the Economy Ministry has called on VW to act responsibly, but declined to comment on the planned cuts. On Wednesday, top executives are expected to address the Works Council over the possible changes. Council head Daniela Carvalho promised it would be a very uncomfortable meeting for the firm's management.